Have you ever wondered what the difference between open-end and closed-end funds is? Well, ponder no more. Today, we delve into the intricacies of these two investment vehicles, comparing and contrasting their features to help you understand them better. Firstly, let's talk about open-end funds. These are what most people think of when they hear the term mutual funds. They are called open-end funds because the number of shares in the fund is not fixed. Instead, it is open to change as investors buy and sell shares. When you invest in an open-end fund, the fund company creates new shares to sell to you. When you want to sell your shares, the fund company buys them back. The price at which shares are bought and sold is determined by the net asset value, or NAV, which is calculated at the end of each trading day based on the total value of the fund's assets. Now, let's turn our attention to closed-end funds. These are a bit different. Unlike open-end funds, closed-end funds have a fixed number of shares. These shares are initially sold through a public offering, and after that, they trade on an exchange, much like stocks. The price of shares in a closed-end fund is not determined by the net asset value of the fund. Instead, it's determined by supply and demand in the market. This means that shares of a closed-end fund can trade at a premium or a discount to the fund's net asset value. So, what are the key differences between open-end and closed-end funds? 1. The number of shares. Open-end funds can issue and redeem shares at any time, leading to a fluctuating number of shares. On the other hand, closed-end funds have a fixed number of shares. 2. The trading process. Open-end fund shares are bought and sold through the fund company at the net asset value determined at the end of each trading day. In contrast, closed-end fund shares are traded on an exchange at a price determined by market supply and demand. And 3. The pricing of shares. Shares of open-end funds are always traded at their net asset value, while shares of closed-end funds can trade at a premium or discount to their net asset value. In essence, while both open-end and closed-end funds offer investors a way to pool their money and invest in a diversified portfolio of assets, they do so in distinctly different ways. Understanding these differences can help you make more informed investment decisions.